Now that we're processing credit transactions, there's just a few little theory questions we might need to deal with that have never really been on the exam a lot, but potentially they are in the study design, so they're things that we do need to consider. And when we're discussing something, we're considering both sides of the argument. So you could call it pros and cons, or strengths versus weaknesses, advantages versus disadvantages, and so on. And one particular issue that I guess potentially is accessible is what are the pros and cons for a business of purchasing inventory on credit? We could argue on the one hand, on the pros or the positive side, it gives the business time now to sell the inventory to customers, collect the cash, then pay the accounts payable or supplier for the inventory with that cash. So when we look at something called the accounts receivable turnover and the accounts payable turnover, what you don't want to do as a business is pay cash up front for inventory and then have to try and sell it because you're stuck with the inventory and you've spent the money. Whereas if you buy it on credit, that buys your business time to now sell it and get the money for the inventory and then use that money to pay your suppliers. So that's a huge pro of purchasing inventory on credit. Another thing that we're going to look at in a couple of lessons time is that we can get discounts for paying accounts payable or suppliers early. It's going to be called a discount revenue. And this reduces the amount we end up paying for inventory, and it will also increase our profits. And we'll look at that later. Also, credit purchases are interest free. When you think about it, if you're buying inventory on credit and just have to repay back that amount, the alternative would be to borrow money from a bank. And when you do that, there's interest. So when you think about it, buying inventory on credit is actually interest-free finance. What about on the con side? Well, it now creates time pressure on the business to sell the inventory and collect the cash before the account payable must be repaid. It's also risky if the business can't repay the account supplier on time. As soon as you start buying on credit, it affects something called your credit rating, and there can be fines and suppliers can stop selling to you if you're not a good account payable and you don't pay things on time. Just with this first issue, it creates time pressure. That's something we'll look at more when we do accounts receivable turnover and accounts payable turnover. What are some other possible discussion points with regards to selling and buying on credit? Well, I guess another one could be, what are the pros and cons for a business of selling on credit? So the main pro is it's an effective way to increase sales and profits as it attracts customers to the business. It's a slightly different thing to Afterpay, but it's kind of similar to Afterpay. We're letting the customer buy something today without paying. That's a great way to attract customers to your business. And secondly, it can be an effective marketing tool. We can distinguish our business from our competitors who may not offer credit sales. What are the cons? Well, there's a huge risk that accounts receivable, which are our credit customers, don't repay the business on time or at all, but we still have to pay our suppliers or our accounts payable for the inventory. So that's going to be called something that's a bad and doubtful debt, which we'll deal with later in the course. But there is always a risk as soon as you start selling on credit that the people that owe you money might not pay. And secondly, we're going to look at something called discount expenses. When we offer discounts to accounts receivable or customers for paying early, that's going to reduce the amount of cash we receive and will lower our net profit. So there's some pros and cons of buying and selling on credit. Another part of the course is ethical considerations, and it sort of pops up through every topic a little bit, and this is potentially one area we could look at and go, what are some ethical considerations when deciding to purchase inventory? So what inventory should we buy? Should we buy a product that's considered to be ethical, or should we not care and just buy something that's doesn't might be bad for the environment or perhaps an unethical product? So I guess we could look at on the one hand, what are some reasons for purchasing ethical inventory? Inventory that society would consider to be ethical. You could argue one reason is we're doing the right thing by society and the community by buying a product that's ethical. So for example, maybe we're using renewable energy and solar energy to run our business, and we're doing the right thing by society there. It also attracts customers who seek to make ethical purchases. So when we look at our inventory now, we could say if we're selling a laundry detergent that doesn't have chemicals in it, that's going to attract a lot of customers who like to make ethical purchases, and they'll buy their laundry detergent from our business instead of other businesses. Lastly, businesses might be able to charge a higher price because often when you sell an ethical product, you're appealing to a set group of customers who like that, and therefore they're prepared to pay higher prices for a product that they consider to be ethical. What are some reasons against purchasing ethical inventory? Well, when you think about it, wouldn't every business purchase ethical inventory if we could? Well, there's got to be some reasons we don't. And usually the main thing is it usually costs the business more than non-ethical inventory. So if we went back to the laundry detergent example, it'd be much cheaper to go and buy a laundry detergent that has chemicals in it. That will cost our business less and therefore cost the customer more. And because that's the second disadvantage, these higher costs from buying ethical inventory might need to be passed on to the customer in the form of higher prices. And lastly, if the business maintains low selling prices, then those higher costs have to come out of our end and in terms of our profit, and they'll lower something called the gross profit, which we'll get to later in the course. And perhaps one more final thing to consider with regard to ethics and inventory: is it even ethical to sell inventory on credit to customers? Are there some reasons for it and some reasons against it? Not in terms of a business case, but in terms of the ethics of it. So we could argue on the one hand, it's quite ethical to sell products on credit to customers because it enables customers to purchase products they need, but they may not have the money for right at this moment. So, for example, clothing. If it's clothing, everybody needs clothing, or say school uniforms. People have to have that. That's a need. That's not a want. And if we enable our customers to buy on credit, you could argue that's an ethical consideration as well as a business consideration. We're enabling customers to buy the products they need, but just might not have the money for at the moment. What about the arguments on the other side? Are there any ethical reasons why we shouldn't sell inventory on credit? We could argue it kind of allows customers to buy products and have debts that they may not be able to repay. They don't have the money to pay cash up front now, so how are they going to find it later on? And it is different to Afterpay. That's not quite buying and selling on credit, but it is similar in the sense that Afterpay just allows people to buy a lot of stuff that they might not need and can't afford to repay later. And that comes down to this second point. It might encourage customers to buy something just because they want it rather than them actually needing it because they know they don't have to pay any money today. And lastly, customers who can't pay within the credit terms, which we looked at, there's discounts that apply and debts have to be paid in a certain number of days. We'll look at when we do bad and doubtful debts, we might need to follow up with debt collectors. And as soon as you do that, that's a great way to cause consumers stress, and it also lowers their credit ratings. So we need to sort of balance the fact that we need to get the money back from customers with the ethical consideration that it can actually create them a great deal of stress and actually make it difficult for them to buy things on credit in the future.